This podcast is for professional investors only.
Our job as investors is to be patient, is to look at the facts, is to adjust where we see appropriate and discount that sort of uncertainty risk into it and take advantage of the volatility that comes. Volatility is a great driver of alpha as long as you are patient and methodical of taking advantage of it.
Welcome to a new episode of the Robeco podcast.
You're tuned into Robeco Market Flash. Asian equity markets have continued their declines days after the announcement by the US administration of aggressive, across-the-board tariff hikes. Asian economies, and China in particular, will feel the brunt of these draconian trade measures. Well, Josh Crabb is head of Asian equities at Robeco and also portfolio manager for Robeco Asia Pacific Equities. Welcome, Josh.
Good morning.
Thanks for joining us from Hong Kong. It was a tough trading day in your neck of the woods. I see one of the worst trading days for the Hang Seng this century, but correct me if I'm wrong. What are your overall impressions of the severity of this market rout and also the damage done to investor sentiment?
Well, I think the appropriate word here would be bloodbath. It sort of reminds me of going back to 2009, so it's been a very brutal day. However, I would make a distinction that I think in 2009 we probably had much more significant fundamental events unfolding. So it's sort of quite interesting. Again, here we have a very significant market event on something that we all knew was coming.
Well, let's go into that. We all knew that further tariffs on China were coming. And we saw there in the Rose Garden when President Trump was wielding that chart, China was at the top of that chart with 34% in new tariffs announced. That's on top of the existing 20% hike. The ramifications of this will be extensive. So what's your read of the situation for China, but also what does it mean for investors?
Well, I think, where we were at the beginning of this year, we had one, main concern. And that wasn't really around the equity markets that we look at. It was some concern around some of the high valuations we saw in the US, and particularly in some aspects of the, information technology sector revolving around the likes of AI. And we've seen some of that start to unravel. Now, clearly in that sort of situation, despite much cheaper valuations in both Europe and in Asia, we have seen, these markets also be hit. Now, again, this has been speculated, and the tariffs did come at the higher end of what the expected range that was being spoken about was. Really, this shouldn't be a surprise. Let's remember, this is not purely around what the tariffs are going to be. It's about establishing a negotiating position. So we shouldn't be too surprised to see this coming at the higher end of the range. Now, again, we always get a bit of panic. And when you do get this type of panic, you get a self-fulfilling prophecy to an extent. It drives things like margin calls, it drives unwinding of book positions, it makes risk limits come down. And I think that's what we're in the process of at the moment.
Okay, so you say we shouldn't be surprised, and yet there is surprise. There is a panic reaction, as you say. At the same time, underlying what you're saying, do you think that this is purely a negotiation tool and that we could see a reversal of these measures and things will go back to the way they were before, as markets seem to want to have?
I think it's a very interesting question. I mean, I think we've all noted the imbalances that sit in the world. Some of that's been around trade, some of that's been around fiscal positions, some of that's been around debt positions. And that was going to have to change. The US needed to start spending a little bit less, needed to improve its fiscal position. We need to see more consumption in the likes of China and parts of Asia as well. We need to see a bit more fiscal largesse in Europe. It's not taken a very orthodox way of dealing with this, but it is dealing with some of these issues. And, so it's not purely around negotiating. And again, it's going to be, like with these things, is the more rapidly they happen, the more unexpected the timing around it, the more dislocation that occurs. But they do tend to occur sooner or later either way.
Mm-hmm. Now, for Asia beyond China, it's also a major blow, and it's clear that the China plus one strategy that many had been banking on, I think, would no longer be a way of escape from this. But interestingly, over the weekend, Vietnam has been one of the first countries to seek conciliation with the US. They've proposed dropping all of their tariffs on US imports. Do you think that will work? And do you think that could be an example for other Asian economies to follow?
Yeah, I think this is a good question. I mean, if we were sitting here today and everyone had immediately come back with retaliatory sort of tariffs and we'd had a real standoff and it became much more around a political, confrontation, then that can actually have quite profound fundamental effects on the market. I guess what we've seen is, like with most of these things, is people don't change unless they're forced to. Now we've come to a point where I think a lot of people are thinking, okay, this event has occurred. What are we going to do? So I think you will see some deal making made. It's very interesting because in Asia, it's not one place, right? The economies are very different. The export orientation is very different. Some of the likes of whether it's India or Southeast Asia don't have that much trade. So it's much easier for them to do those type of deals, and they may actually have some benefits that come off the side of that. For other countries, it's going to be a little bit more difficult to sort of get through that process, and it's going to require more of a shift to a domestic orientated economy as well. So I think we will see those deals get done. Again, the more, like with most negotiating, some people like to go in there with what they see as a reasonable deal. Some people like to go in there with something so outrageous because they think they can barter down to something that makes more sense. So I think so far what we've seen, and again, we saw similar things with defence spending in Europe, that the outcome, hopefully we get to the right place.
Josh, take us through your own thinking on how you are positioning or repositioning your portfolio, which covers the Asia Pacific region. So you mentioned India and Southeast Asia, perhaps more insulated from these events, but I'm sure they will not escape if there were a decline in global demand and trade, for example. So by country, are you adjusting your positioning, and why?
Yeah, I mean, to be honest, not because of today's events. I mean, it's a bit late. And the problem with doing these things is you need to be ahead of where that sort of sits if you want to take advantage of that. So for our perspective is when you do get these events, and as I sort of said, there was nothing that really came out that should be that shocking. The shock has been in the market reaction. So from our perspective, are we doing anything dramatically to change our positions? No. Had we moved to take advantage of, more defensive sectors? Yes. But a lot of that was more driven by the fact that that's where the valuations were starting to look attractive already. We'd seen the likes of Japan seeing, wages starting to go up. So it just drove our natural sort of, desire to be in those type of companies to take advantage of that. So for us today, to the extent that, again, we thought markets were a little bit expensive, maybe there's a little bit of cash that we can tactically take advantage of as this settles down. But the real game here, as you mentioned before, is we have a correlation that's very high. And what that means is people don't distinguish between companies that are more or countries that are more or less impacted by what's likely to happen here. And that for us is where that real opportunity sits. Rather than getting caught in the headlights of the macro, sit there and think, okay, which companies are the relative winners here, and take advantage of that.
So you're doing that? Are you doing that on an individual bottom-up stock selection process, or are you saying certain sectors might escape this and are being punished unnecessarily?
Yeah, it's a bit of both. And again, none of this happens in a vacuum, right? I think one of those great Latin phrases that used a lot, ceteris paribus, everything is equal. The reality in the world is that everything is never equal. There are lots of things that are changing. So again, if we go back 6 months ago, India was a really expensive market. We didn't see a lot of value there, even though we think it's a great long-term story. Now that market has sold off for reasons nothing to do with this. And it's also been caught up in the sell-off that we're seing today. So is that going to throw up some stock-specific opportunities for us? Probably they will. Again, as you mentioned before, it's like, there are certain things that maybe we see moving back to the US, but you're unlikely to see people working for $10 or $15 a day in the US. That's just not going to change. No matter what economic aspects happens, that's not going to change. So those jobs or that activity is still going to happen in certain parts, of Asia. And we think, again, that's an area we can take advantage of it as well.
Josh, listening to you, what I'm hearing is your messaging is leaning towards a buy the dip mode, as opposed to, we spoke to a colleague of yours, Colin Graham from Robeco Investment Solutions. To him, he says it's possible that this is a whole regime shift in the way the world functions and operates. But in your perspective, where are you on that continuum?
Yeah, I think that's always where the starting point is. Like, again, as I said before, I think in some parts of the US market, some parts of tech, valuations were very high. And that means they can continue to come down. And we've seen quite a big divergence, even looking at the US market, between the Dow Jones and the NASDAQ. And that's because when people go risk off, the immediate thing is that things move together. Then the question is whose earnings are most at risk? Whose valuations are way too high for this new level of uncertainty that we're going into? So for us, Asian valuations are okay. If we look at the likes of Southeast Asia, they're actually had great prospects. They have relatively low exposure to the tariffs, and you had very, very good valuations. So for areas like that, we still think that shouldn't be a place that people run away from, and we will, look to take advantage of that. Again, India, as I said, if you'd gone back 6 months ago, it was expensive, so we might not have had the same reaction, but the market had massively underperformed. It had got to a reasonable sort of level, and now it's getting hit equally as much. And again, these are the types of markets where it's much easier to do a deal. And if they do a deal because they don't have to give as much up, they can actually benefit from that.
Josh, you sound incredibly sanguine and calm in reflecting on the day's events. But I'm sure that you and many other investors are, thinking hard about, what's up next. What would be your words of wisdom for investors in this interesting time?
Yeah, I think with investing, it's a very simple thing. Like you're getting to buy something a lot cheaper than you were a few days ago. So if you liked it a few days ago, you should like it more today. I think that's that sort of trait of investment, right? Is like, we should always want to buy things when they're on sale. You do with most other products, and the investments are no different. The future path that we're going to take was always going to be the future path that we're going to take. It's just at a certain point in time, some of those things offer better value. Now, as Keynes would say, if the facts change, I change my mind. And some aspects of that will be relevant. And that's where you have to watch what's going to happen. You're going to have to look at the deals that are done. You're going to look at the people who don't put politics in view of getting to the best possible outcome. And there will be winners and losers in that. Our job as investors is to be patient. It is to look at the facts. Is to adjust where we see appropriate and discount that sort of uncertainty risk into it and take advantage of the volatility that comes. Volatility is a great driver of alpha as long as you are patient and methodical of taking advantage of it.
Josh Crabb, thank you for your time.
Pleasure.
And to listeners, stay tuned for more market flash updates from Robeco.
Thanks for joining this Robeco podcast. Please tune in next time as well. Important information. This publication is intended for professional investors. The podcast was brought to you by Robeco and in the US by Robeco Institutional Asset Management US Inc., a Delaware corporation as well as an investment advisor registered with the US Securities and Exchange Commission. Robeco Institutional Asset Management US is a wholly owned subsidiary of Oryx Corporation Europe NV, a Dutch investment management firm located in Rotterdam, the Netherlands. Robeco Institutional Asset Management BV has a license as manager of UCITS and AIFs for the Netherlands Authority for the Financial Markets in Amsterdam.